Good morning, everyone. This is Rong, Senior ESG Business Development Manager from S&P Global Sustainable One. I'm really glad to have the opportunity to be here today and share our views on climate risk management and best practice on TCFD reporting. First of all, I would like to give a quick introduction of S&P Global as we offer a comprehensive range of ESG solutions across different divisions. We are very well known for our ratings department, and under ratings we have ESG evaluations, green bond evaluations, and different kinds of ESG related products and services. Under S&P Global Market Intelligence, we have True Cost Data, which is the world's biggest environmental and carbon data set, which houses more than 22,000 companies' environmental and carbon information. We also have ESG scores that a lot of asset owners, banks, asset managers are using to integrate into their investment process. And for SP Dow Jones indices, in 1999, we actually launched the world's first sustainability index, which is the DJSI, Dow Jones Sustainability Index. As of today, we have more than 150 ESG-themed indices, and it's being tracked by global investors. This year, on April 22nd, we launched S&P Global Sustainable One with the goal to provide a one-stop single source of essential sustainability intelligence for the global financial institutions and investors. So having said that, today I would like to cover three topics. First, the value of TCFD reporting. Second, preparing for success on TCFD reporting. And the last one is how data play a role in enabling TCFD reporting. So first of all, in terms of TCFD, it's really a big momentum that we can ignore today. As of this month, the supporter for TCFD has grown to over 2,200 organizations. That's representing a market capitalization of over 12 trillion. And if we look from the region allocation perspective, Europe and Asia are actually leading the momentum. And from a time perspective, you can see from 2020 to 2021, you can really see the very sharp increase. So for example, this year earlier, a lot of Chinese institutions like E-Fund Management, Bank of China, Construction Bank of China, they all became official TCFD supporters. Apart from financial institutions, there are also an increasing trend of corporate TCFD supporters. We can see a lot of familiar names here, and the list is growing and growing, which is a great thing for a lot of investors and banks because we need a lot of data in order to analyze climate risk. The more corporate disclosure on climate-related financial risk, the more information we can gather and collect in order to conduct our financial institutions' climate risk analysis. So what is TCFD? TCFD stands for the Task Force on Climate-Related Financial Disclosures. And it was launched by G20's Financial Stability Board in May 2015. And it's really a task force driven by a number of large central banks, asset managers, and asset owners. And TCFD it's really providing a framework and a strategic lens for investors, lenders, insurance underwriters to address and disclose on material climate-related financial risks. So why it is important? So TCFD recognized that climate change is the only unmanaged financial risk to the global economy. It's including, wide-ranging physical impacts like sea level rise, hurricane, wildfire, but also, a lot of uncertainties embedded in the low carbon transition of the economy. And if those risks are left unmanaged, those could have significant disruptive consequences on asset valuations, and it will eventually affect global financial market stability. So financial market players really need clear, high-quality information to understand and manage climate change risks. TCFD really categorize climate change related financial risk into two categories. So the first one is transition risk. That include policy risk, technology risk, and all the uncertainties that as we transition from a carbon intensive economy to a low carbon economy. And the most major type of risk is carbon pricing risk, which we already seen, a national emission trading system established in more than 50 global markets. And the second category is physical risk, which can be acute physical risk, like extreme weather events, a flood or a storm that come really urgent and affect the whole city or region's economic productivity, or it can be chronic, so long-term sea level rise that affects real assets. Apart from risks, TCFD also introduced the concept of climate-related opportunities that including, increased revenue from new products and services, and also reducing operating costs if we effectively manage our carbon emissions. So the main questions for financial institutions is really about how resilient your business models are under different climate scenarios. So for example, in 2030, 2050, even longer term. On the right-hand side of my slide, it's the way how we translate transition risk and physical risk to financial impact. And that's the key message of TCFD, because climate risk has an impact pathway to our financial statements. It affects our revenues, our expenditures. Also, more and more often, it actually affects our access to capital. And for those, really carbon efficient companies with good ESG performance, their cost to capital are increasingly competitive. So if we look from a regulation perspective, there are different momentums, issued by different governments around the world. In Hong Kong, we definitely see a rapid transition in terms of, government actions on guiding climate-related financial disclosure. So Hong Kong, in May 2020, there was a Green and Sustainable Finance cross-agency steering group set up, and it's co-chaired by Hong Kong MA, the Monetary Authority, and the SFC, Securities and Future Commission. There are different other members involved, like the stock exchange, like the Financial Service and Treasury Bureau, and the aim is really to coordinate the management of climate and environmental risks to the financial sector. So the cross-agency steering group, they laid out 5 near-term action points, and the most two prominent one I listed here, including first, climate-related disclosure aligned with TCFD, and they expect it will be mandatory no later than 2025. The second important action is they would like to promote climate-focused scenario analysis, which means financial institutions needs to conduct scenario analysis and stress testing under different climate pathway. So if the world is transitioned to a 1.5 degree or a 2 degree, what will that be? What will be the impacts on our loan portfolio and investment portfolios? And if we look at the mainland China, so in 2020, towards the end of the year, Chinese government announced its pledge to achieve carbon peaking by 2030 and carbon neutrality by 2060. So it's really the first national commitment that the government has announced. And since then, the carbon neutrality momentum is huge in China among financial institutions like all the big banks and investor universe. This year is actually the beginning of a national emission trading system in China. China has been piloting ETS for a few years across different piloting cities. And this year it's really establishing the national trading, which brings the world's largest ETS live. So with that, we expect a lot of economy players, like companies from different industries, will start to address the increasing carbon cost coming from the emission trading system. And regulators like the People's Bank of China, they aim to make climate risk disclosure mandatory for the financial sector in the very near term. If we look at Europe or US, there are different momentums around climate risk disclosure. And it's really a mainstream trend that worth understanding, and it's becoming a C-suite agenda on financial institutions and corporate C-suites. I've listed a few other regulatory development here. We can see that UK announced that they will ask across the economy, all companies to produce TCFD aligned disclosure mandatory by 2025, which is very likely by 2023. Canadian firms actually have to file TCFD reports if they want to get COVID-19 bailout. And from the investor side, BlackRock has been leading and driving the TCFD and ESG momentum. So in their CEO letter, they have said, they want their investee companies to disclose climate-related risk in line with TCFD recommendations if they haven't done so. Earlier this year, there was a big news that BlackRock backed up the voting out of three directors from ExxonMobil, which we expect to see more and more investor actions like that. Similarly, CPP, the Canadian Pension Fund, they also, publicly require their investing companies to report in line with TCFD requirements. So, having said that, if we look around, we see that a lot of central banks and financial institutions have already started to walk the talk. They have issued their climate risk management reports. And in 2020, S&P Global True Cost actually helped the Bank of England to issue their first climate-related financial disclosure. They used our environmental and carbon data set in order to calculate the carbon footprinting of their loan portfolio under different time scenarios and climate scenarios. We also helped Bank of France and the Pension Reserve Fund of France to do similar climate risk analysis, looking at their portfolio against a benchmark to understand how the portfolio is performing. And another example with Japan's government pension investment fund. So we analyzed a multi-asset portfolio that including equities, debt, private equities, real estate, etc. Ranging from carbon footprinting of the portfolio to understand the carbon earning at risk, how the portfolio would react to different carbon price across the world. Also, examples for Shinhan Financial Group is a new analysis that we help them perform. And also an ICBC, the Industrial and Commercial Bank of China. So True Cost supported the development of environmental risk stress testing. And the results is one of the most industry-leading report that being widely used in mainland China. So that leads us to our second topic, how to prepare for success on TCFD reporting. TCFD reporting, we often hear from, the industry that it's difficult, it's challenging, it has unique reporting features because unlike other ESG reporting framework, TCFD is about forward-looking, and it's about understanding what the climate change impact will do to our business rather than the traditional lens, what our business is doing to the society, to environmental, and to the broader economy in general. So TCFD is another lens, understanding the impact on our business. It's forward-looking, it has to range from 2030, 2050, or even longer term based on where you're based. There are a lot of uncertainties embedded because when we look at future scenarios, there are different possibilities. The world have a scenario of 1.5 degree or 2 degree or well below 1.5. Also, how do we link financial risk to financial impact? The carbon price, how that affects our loan portfolios, default rate, loss given default, different metrics, etc. And also, how does that impact our strategy? How do we incorporate into our lending decision or investment decision? It's really a new thing that a lot of institutions are start to piloting and understanding how to better manage this unmanaged risk categorized by TCFD. So different challenges, I've listed a few here that including organization learning. So how do we build the capacity within the organization, build the alignment of understanding across, different layers of management. Another challenge is internal gathering. There are a lot of traditional data points that are readily available, but when we get to TCFD, when we want to assess climate-related risk, there are new data that we need to start gathering and understanding and incorporate into our existing risk management process. So different challenges exist, and specifically on financial institutions and banks, I've listed key disclosure requirements from TCFD. That including, analyze the amount and percentage of carbon-related assets relative to total assets. So understanding, what are our stranded assets exposure across our loan portfolio. Also, how much emissions are we financing in terms of corporate lending, in terms of the infrastructure and project financing that the bank is doing. And also the amount of lending and financing connected with opportunity, not just risk, but also understanding, what's the current size and the future vision for financing low carbon projects and opportunities. And also, how do we categorize climate risk in the context of, credit risk, market risk, liquidity risk, and operational risk, and also doing the scenario analysis. So there are, relevant interpretations for banks, and S&P Global Truecost, having been working in environmental and climate analytics for 20 years since 2000, we have developed a very mature methodology to help investors and banks to stress test their portfolios, which include retail and corporate loan books, and that can cover, physical climate risk. We are currently tracking 7 most common physical risks: wildfires, droughts, heat waves, cold waves, hurricane, typhoon, and sea level rise. We can also do the transition risk analysis. So, understanding the potential earnings at risk and how that affects our loan portfolio resilience. And also, S&P Global can help you integrate all those climate risk analysis into your investing and lending decisions, and eventually produce a external facing climate reporting and disclosure that are well aligned with TCFD requirements. If you guys are interested, feel free to check our website. We have issued a thought leadership paper on 7 ways to inform better decisions with TCFD reporting. And we've listed, the most useful and effective approach to start the journey and eventually evolve, from the beginning to the more advanced responses to TCFD. And next, I would like to talk about essential data. If we want to do TCFD reporting, data play a very critical role. So Here we have listed the key steps of aligning with TCFD recommendations, and the first one is setting a baseline. So that including, understanding our carbon footprint of the current loan portfolio or investment portfolio using different metrics like the weighted average carbon intensity, WACI, which is recommended by TCFD. But there are also other metrics that we can explore. Also understanding, what's driving the portfolio carbon performance relative to benchmark, who are the biggest contributors to our loan or investor portfolio's carbon emissions. By doing the baselining exercise, we're able to create a clear view of where we stand in terms of our current status. And then the next steps is to add a sector-specific metrics. So understanding, how much of our loan or investment portfolio are exposed to stranded assets. And by speaking of stranded assets, we mean those fossil fuel exposed assets that are likely to be impaired assets if we do not take any actions. We also want to understand the renewable share in energy mix that we're financing, how much of our portfolio is allocated to low carbon projects, technologies, and opportunities that related to a low carbon transition. And the third step is about conducting scenario analysis, and it's the very essential step to understand TCFD. And that including, analyzing transition risks and physical risks. And under transition risks, the most commonly asked is about, how would carbon price affect my portfolio? And that can be analyzed using S&P Global's carbon earning at risk data sets, which would help you analyze the potential percentage of earnings at risk from future carbon pricing scenarios, which include 3 different scenarios specified by the IEA, International Energy Agency. We can also analyze the Paris alignment of your portfolio, how much more than the agreed 2-degree scenario that your investment is currently performing at. So is it at 5 degree, which give a red flag that we need to do something, either decarbonize our portfolio or other actions, including active corporate engagement, or reconstruction of the portfolio, etc. And from a physical risk perspective, as I mentioned, we can analyze 7 different physical risk indicators. That's also across 3 different scenarios up to 2050. Also, from a positive perspective, we can analyze opportunities related to our portfolio using the United Nations Sustainable Development Goal Framework as an alignment tool. So SDG is a very common used framework to assess positive impact of a portfolio. And S&P Global's SDG dataset can actually help you understand each of the 17 SDG goals and how much of your portfolio is contributing to each of them. And also from a risk exposure perspective, based on the investment company's operational location or headquarter location, we can analyze, what are the SDG goals that the company or your portfolio should be aware of, from a risk perspective. We also have the EU taxonomy dataset, which is very much in line with the European taxonomy and can help us analyze the proportion of the investment company's revenue linked to the 670 taxonomy-aligned business activities. And that's also a very popular framework to measure positive impact of portfolios. And also from the, the next steps, the last step is reporting and external disclosure. After internal management analysis, if we decide to do external disclosure, then there are a lot of examples that S&P Global Truecost have produced, and it's available online. And I'm happy to share many of the examples after this session with our audience who are interested. So in terms of the data set, if we have a closer look, the most signature one and the most frequently used one is the environmental and climate database, which we started establishing since 2000. And that including 22,000 companies representing 99% of the global market cap. And if we look at, all those data are actually backing or being used in different indices. If we look at how that looks, I've put an example here. So this is the S&P Global's Market Intelligence desktop, and there's a company example here showing the environmental profile, including carbon emissions, scope 1, scope 2, scope 3 of the company, and there are different tabs to look at different indicators like, environmental damage costs, air pollutions, greenhouse gas emissions across different years. So it's really easy use tool. Like once we enter the company information, we can search for the environmental profile of that company. And this market intelligence tool have also, sovereign carbon data across more than around 200 companies. It also enable us to do portfolio analysis tools, company screening, and real-time ES news and research. So in terms of portfolio analysis tool, I've put an example here that we can put our customized portfolio against a selected benchmark, and then we can decide what type of portfolio analysis we would like to see, whether it's carbon footprinting, physical risks, or other type of analysis. And in terms of the portfolio analytics, the tool is a very easy and effective way. We also produce customized portfolio analytics for financial institutions. I've listed a few examples here, like carbon footprinting analysis, understanding across different industries what's our portfolio footprinting, and also how do we perform against benchmarks. We also have the forward-looking carbon earning at risk, looking at 3 scenarios, 3 time horizon, and similarly for physical risks, 7 different hazards, 3 IPCC scenarios, and also that includes 2.7 million asset level physical risk analysis across the 7 different hazards. Example here is one company, it has assets around the world, and we would actually map the location across to the hazard map and produce a risk score for each of the asset location. And this is the results, illustrative results for hurricane risk. So that marked the end of my presentation, and I would really love to welcome any questions you have. And if you have any other follow-up inquiries, feel free to reach out to me, and I've listed my contact here. And that's it, and I hope you enjoy the session, and hope you have a great rest of the day. Thank you.